This is segment one. Hello again, this is Tom Harris. I'm director of the University Center for Economic Development. This is part one of a four-part podcast on Nevada agricultural policy. This first session is on the economic environment, which covers both international and national economic trends. If you think what's been going on currently with the Chinese economy and with the European Union, these will influence Nevada agricultural prices. Mike Helmer will be doing the discussion of these. And Mike, what do you have to say for us about the economic environment?
Well, the economic environment is extremely important to agriculture in the U.S., around the world in the U.S., and even into Nevada. You know, we tend to think of Nevada agriculture as being very locally oriented, but the fact is that the global economic setting has a big impact on what happens in Nevada. I'd like to start off with looking at just GDP growth or income growth in various countries around the world. And if you look at the first slide here, we have just some GDP growth estimates, both for the recent history and for the next 5 years in the outlook. And if you look at the slide, the vertical line is for 2016. That tells you where we're at right now. And you can see from that even looking across all the regions that we have there, we have the world, we have emerging economies, which are China, India, former Soviet Union, regions like that. We have developing economies, which are among the poorest countries in the world, but they're growing. We have developed economies, which are like the US, the European Union, Japan, Canada, Australia, and so forth. And you can see that the rates of growth vary quite a bit from region to region. As a matter of fact, the emerging economies are the fastest growing. And this chart that we have here is in per capita GDP, and it's inflation adjusted, so that we can look at in terms of per capita GDP that our emerging economies, and those are this is primarily driven by China and India, and to a lesser extent the former Soviet Union, are by far the fastest growing regions in the world. The slowest growing region of the world is the red line, which is our developed economies. Now that's kind of notable because those are the countries that, like the U.S., that it doesn't really matter how fast those economies grow from an agricultural product consumption point of view. I mean, think of it in these terms. If my income increases by 25 or 50%, I'm still going to eat and wear pretty much what I do now. I'm at the income level where that demand has already been developed. But when you start turning to countries that have less of lower incomes, like the emerging economies and the developing economies, those are the ones where income growth really starts pushing food demand and fiber demand. So as we look at the developing and the emerging economies, those are the ones that are really going to drive growth in economic consumption and in trade as we go forward through the next 5 years. And one thing that I do want to mention, though, is with the developing countries, they've got a per capita income, that whole group of countries together, of about $2,000 per year. That's very low, particularly when you think of it in terms of developed, of over $40,000 per year. Some of these countries are very, very poor countries, and they're much less than that $2,000. And so what happens in a lot of those countries, they have subsistence agriculture that they eat on. Increasing their income a little bit doesn't really drive their food consumption or their ability to import. So that ability for the developing countries to add to agricultural growth, or the agricultural market growth, is somewhat limited.
Could I ask you, on your graph there, the developed countries really took a decrease during the Great Recession 2008 and have jumped up a lot. Does that mean there's going to be a lot more demand for commodities by the developed countries?
No, we did see some decrease in those, but again, the developed countries we've got that demand already formed. And it did decline some, but it's not going to increase very much. We're going to take that income that we earn, and it's not going to go towards food and fiber for clothing, but it's going to go to other things, other consumer items. We're going to buy more cars. It's going to push housing prices are going to go up in real terms, and that sort of thing. We are not going to increase our food consumption very much. We may eat out more. We may change where we spend that dollar, but we're not going to really increase what we eat very much because we already have a very high well-developed diet.
Yeah. There was one time in the Eisenhower administration, the U.S. Department of Agriculture Secretary tried to get everybody to drink an extra glass of milk. Well, you're not going to do that.
Yeah.
Okay, Mike, let's go to your next slide.
Okay, Tom, where I want to go with this one is start looking at the purchasing power of our trading partners.
Okay.
And we look at that through the exchange rate. And with the slide that I've got here, again, the vertical line is 2016, about where we're at now. But I've got two lines on here, just kind of make this a general discussion for the moment. Since 2011, the dollar has strengthened quite a bit compared to most currencies around the world. And this shows just kind of a basket of global currencies, an average exchange rate, if you will. The blue line is the actual exchange rates all bundled into one basket, and you can see that it increases, which by this chart, what that means is that the dollar has strengthened considerably. The red line, though, is if we adjust for inflation differences between the U.S. and our trading partners. And this shows that our trading partners haven't quite lost as much purchasing power. The weaker their currency, the less purchasing power they have on the international market. And so the dollar, though, even between 2011 and 2016, the red line, even when we adjust for inflation, means that the dollar has strengthened about 20% relative to a basket of currencies around the world. That's a big reduction in purchasing power from our trading partners when they want to buy American goods. It costs them, if the prices hold constant, it costs them 20% more. But as we go into the future, both in nominal terms, the blue line, we do expect after a couple of years to see the dollar weaken a little bit. And when you further adjust that for inflation differences between our trading partners in the U.S., that is weakening even more. So our trading partners get a little bit of that purchasing power relative to the dollar back.
And that is important for our ag commodity exports because it makes them more expensive.
That's right.
Next. Now the next.
This is just kind of a continuation of that thought.
Okay.
But I wanted to break it down into some regions that we looked at, again, the developed, developing, and emerging economies. And we can see, and this is now, all these exchange rates are adjusted for inflation differences. So this is the true purchasing power, what's going to happen. And so that we can see that across the board, once we get beyond this year, the countries, our trading partners, are not going to lose purchasing power relative to U.S. Commodities. The dollar is going to remain strong, relatively strong, but it's not going to strengthen. They won't lose more purchasing power. Particularly if we look at our developing regions, we see that purchasing power starts to come back a little bit. That will help those countries be able to feed their populations. The red line and the blue line kind of sit together. The blue line is just a global average. The red line is the developed countries. Our trading partners, and this is primarily the European Union that is doing this to us, will strengthen a little bit their ability to buy U.S. goods. The emerging economies, this is largely a function, that's pretty flat. That purchasing power won't change, but that's largely a function in here of China is just so big within that group that they overwhelm a lot of other things. And China does keep its currency under tight wraps.
True. The next one covers oil price uncertainty?
Yes.
Okay.
Yeah. So oil prices are very important to the global economy, to all parts of the economy, including agriculture. If you think about oil prices and what they mean for the American consumer, first of all, it's you have to transport goods to market. That becomes more expensive. If gas prices get higher, we've got less money to spend on other things. Mm-hmm. But also for agricultural producers, or for industry in general, but agricultural producers especially, oil prices are very important because they drive fuel prices. And agriculture in this country, particularly, and in developed countries around the world, is dependent on the fuel.
Well, petrol fuels and fertilizer and everything else are hidden in there also.
That's exactly. That's it. And so not only does just field work for tractors and transporting goods to market be important, but there's almost no good in this country, including inputs into the agricultural production process, that do not get severely affected by oil prices. So oil prices become a very big driver of cost of production in here. Now, as we look, we all know that the oil prices crashed last year and have come down farther this year. The projections are that the oil prices are going to rise over the next several years. And there's a few reasons for that. But first of all, I just want to note that in February of this year, oil prices actually dropped below $30 a barrel for a few days. Mm-hmm. Today, they're about $51 a barrel. So you can see that in less than a year, oil prices have gone up by about 75%. Mm-hmm. And still, they're relatively low. And we expect oil prices to go up over the next few years, and there's several reasons for that. One of the reasons is that recently OPEC has reached another agreement to constrain production, which will keep a lid on oil prices. The other thing is that as we move through the next few years, the global economy will begin to grow, and it will increase demand for everything, which will drive up demand for fuels. And so those are some very big drivers of that. Having said that, if we look at where we expect those oil prices to go in 5 years, this projection, up to about $80 a barrel. And that's significant because at $80 a barrel, what we find is that exploration begins to increase quite rapidly. They bring more rigs on, they explore. Mm-hmm. And in addition to that, there's still kind of a hangover of capacity from the last high oil price era when we did a lot of exploration. Sure. Not only did we explore and find new reserves and new supplies, but we also developed them. Exploration doesn't necessarily develop them, but we developed them. And as prices dropped back to the $30 and $40 a barrel, a lot of that production went offline. That's production that can come back on very, very rapidly as oil prices rise. And at $50 a barrel today, if that's sustained or increased, we'll start seeing some of that increase, some of that production come back on. And we're talking about places like North Dakota, which 5 years ago was just an absolute booming oil industry. Today, a lot of those places are ghost towns. Sure. And they can come back very, very quickly because the infrastructure is still sitting out there on the oil fields. And it can be brought back into production. All they need is to hire and bring the trucks and the transportation back in. Additionally, places like the tar sands of Canada can come back online. Now, there is one set of risks to the oil price that I'm finding very interesting right now. And I don't know how big a risk it is. There are a lot of risks around oil production. But right now, one of the risks is the upcoming U.S. election. And why is that a risk to oil prices? Well, depending on who gets elected, we're going to have a different environmental mindset in the White House and in the Department of Interior, Department of Energy. There'll be a large mindset. If, say, for example, the Democrats control the White House, we're probably going to be a little more constraining in terms of oil production and oil transport. If the Republicans win the White House, we're probably going to see more exploration, offshore stuff, off our shores, being developed and produced, and we're probably going to see a lot of the issues that we see right now, like the pipeline be completed, the issues of bringing that through some of the Lakota lands up north in the northern plains. That's liable that will probably happen, is more likely to happen under a Republican administration, I believe, than under a Democratic one. So that's a little bit of a risk. But having said that, the U.S. production in the last 5 years before the oil price drop really increased. The U.S. has the potential to become very close to self-sufficient in oil. And if prices get high, a lot of that production can come back on board and help dampen prices in the U.S.
Which will then impact agriculture
profitability. Yeah, which is why that $80 mark is I believe, and other oil analysts that I've looked at around the country believe is kind of a threshold mark.
Okay. Yeah. Your next is on interest rates, and this is always given the Federal Reserve. Everybody listens when Janet Yellen talks. Everybody listens. But what's this graph telling us for agriculture?
Well, what we're looking at, again, the black line is about where we're at now. We see that the short-term interest rates have risen a little bit. The long-term, not quite so much. I mean, we think in terms of mortgage rates and things of that nature. They haven't really risen a lot. We've seen, the Fed funds rate was actually bumped up by a quarter of a point a few months ago. But it's not growing very rapidly. But interest rates are very important, not only to agriculture in general, but now there's a development in Nevada that is really going to be impacted by interest rates. And that is the dairy expansion, the dairy herd expansion that we need to have in this state to help feed the fowl and whole milk powder plant. If we look at the long-term rates, we see them increasing, and they don't go back up as high as they were, say, at 2000, but they get to be relatively high. What this means is that's a long-term rate that you would borrow for things like expanding your herd or your facilities, building a new facility, like if we want to, if it wants to bring in new buildings into a dairy farm and that nature. So those long-term rates are more for that longer-term investment. As those rates rise, it's going to be harder for our dairymen to do the expansion that they need to do. The short-term rates are more important for annual production costs. A rancher or farmer make short-term loans to cover production costs for the year until they can market their produce. So both of those are going to go up, and so that means that in terms of operating agriculture and expanding agriculture, the costs of that are set to go up in the next 5 years.
So so that's going to be it for this economic environment. There's a lot of factors that Mike talked about: international markets, the oil market, and the interest rates would all change. Again, this is an education program, and we're not making any financial recommendations. If you have any comments that you'd like to make on this podcast, we do have areas that you can make comments and continue the discussion. I hope you find it helpful, and we will proceed to other podcasts covering Nevada agricultural products. Thank you.